In an attempt to rein in on run-on inflation and rescue a weakening shilling, the regulator revised upwards its lending rate by 400 basis points to 11%, a decision aimed at controlling borrowing and tame the soaring cost of living. The Monetary Committee, which met today in less than 4 weeks, also expressed its commitment to revising the central bank rate further if the cost of living, that is inflation, and exchange rate volatility showed no signs of abating. In its last meeting 2 weeks ago, the CBK raised the rate to 7%, receiving criticism from far and wide for not being decisive. An increase in the CBR is expected to make it expensive for commercial banks to access funds from the CBK credit window. Consequently, this cut in money supply into the economy will calm inflation and soothe the weakening shilling, both of which threaten to put brakes on growth. CBK has frequently increased the bank's benchmark lending rate to discourage household and business spending in order to contain inflation. The bank admitted that previous adjustments had not satisfactorily supported the local currency. The increase is supposed to support the shilling as demand for imports slows down. On the other hand, the new measure will see commercial banks raise their interest rates in the coming days, a move that will slow down borrowing and hurt economic growth. Analysts, however, say it will not sit well with Kenyans already battling high inflation rates at 17.32%. Already a number of commercial banks have reviewed their cost of borrowing to an average of 16%. The regulator has been on the spot over what the market observers termed it as slow reaction in saving the shilling. Last week, the home unit fell to a historic low of 104 against the US dollar, before gaining an average of 101. In its meeting with members of the private sector as part of the team set up by the Prime Minister to look into the ways of strengthening the shilling, the central bank pointed towards raising the benchmark rate but agreed to reveal a sense of where the shilling should be and provide support within the range to ensure predictability of the shilling. The team is, however, expected to present its final recommendation to the Prime Minister on Thursday. But while the action of the CBK will spark confidence in the currency market, predicting the direction of the shilling is still uncertain. This is largely informed on the basis of the Eurozone debt crisis that the CBK has little control of and may cause more jitters to the local unit.